Good morning and welcome to Charting Markets on Monday, the 6th of November 2023. What a difference a week makes. I mean, last week what we saw is a risk-on sentiment after the Fed, basically by market participants, was no longer expected to hike its rates and might have thus reached the peak of its cycle. And that basically led to the US dollar selling off and also to equity markets rising very sharply as bonds yields dropped the most in the last 12 years, if you exclude the times during the COVID pandemic. And basically what's happened now is that rate cut expectations for the end of December of 2024 have increased to 95 basis points, that is to say, for rate cuts. And only last week, that number stood at 65 basis points of rate cuts by the end of next year. So basically, the markets have, especially on the equity side, rallied on that news that the Fed remains dovish, on the expectation that we will no longer see rate hikes in the US cycle currently, and that therefore the odds of a soft landing in the US economy have greatly increased. So if you look at the FTSE 100, we can see here that the UK blue chip index also benefited from the rally we saw in the US indices. And as we can see here, we rallied very close to the orange line here, the 55-day simple moving average at 7,497 on Friday, and basically rallied to 7,484 before coming off again on some profit taking towards the end of the week. Now, earlier this morning, we basically traded back around those closing levels of Friday, as the data calendar is relatively empty for today. And basically, we're hovering above these lows going back to September and also October, early October of this year, between 7,384 and 69. So that's our support area for today for the FTSE 100. And yes, it's normal to see a short-term consolidation when the market has rallied quite sharply, as has been the case last week. But from a technical perspective, provided we stay above the lows going back to basically March of this year, between 7,228, the July low, and 7,204, the March low, provided we stay above that key support area, I wouldn't be surprised if we were to head back up again towards the 200-day simple moving average, and also the highs seen back between June and October of this year, between 7,688 and 7,747 into the year end. So you can see here we're trading in a wide sideways range here. And it looks to me as if, once again, we've bounced off support, and that over the next few weeks into the end of this year, we could be heading back up again on that risk-on sentiment, which is mainly driven by US markets. But not only, because if you look at the DAX 40 contract, the German futures contract, in this case, it's actually the cash index of the DAX 40 here on this daily financial bet. We can see that last week we had a very sharp rise as well, one of the sharpest this year. And that took us back up to Friday's high at 15,268, below which we're currently short-term consolidating in low volume. But that's to be expected. I mean, earlier this morning we had German factory orders which beat forecasts, but they didn't do much to prop up the DAX 40 contract. And with no meaningful data out this week, and most of the earnings in the US have also been coming out over the last few weeks, not much is going on today. And from a technical perspective, we have some minor support basically around the 15,034 low. That is the low from the 6th of October, the psychological 15,000 mark, and also this low here, the early October low at 14,944, which could perhaps in the days to come act as pretty good support. But once we continue this sharp rise we saw last week, which I expect to be the case, we should be heading back up again to the orange line here, the 55-day simple moving average, 15,385, and also this July to November downtrend line, 15,420. Now, above there is some pretty important resistance, and that is to say it is the resistance made up of the July low and also the mid-September low, and this comes in between 15,455 and 15,561, and then slightly above that we've got the red line, the 200-day simple moving average at 15,656. So these are all potential upside targets for the DAX 40 contract in the days and weeks ahead, and will remain valid as long as we stay basically above the low we saw last week. Well, actually the week before on Friday at 14,589. Now, if we look at the S&P 500, it actually had the strongest week of gains last week. As you can see here, we had 5 consecutive days of gains, and we basically rallied from this 4,104 low on the daily financial bet, which was made towards the end of October, which incidentally coincided with the late May low, and have risen all the way through the September to November downtrend line and closed above the orange line here, the 55-day simple moving average, all of which is positive for the S&P 500. But we still need to see a daily chart close above the mid-October high, in this case on the daily financial bet at 4,398, for bottoming formation from a technical perspective to be confirmed, because in that case, this will have been a false breakout to the downside, and then we take out the last reaction high here. That is then a bullish reversal signal, which could then take us not just up to the 4,540 September high, but probably also to above the 4,607 July high before the end of the year. So positive momentum being seen in equity markets on those rapidly falling yields in the US, and on the expectation that the rate hike cycle might have just ended at the previous rate hike we saw just a few months ago. The dovish Fed, and also the expectation that it will no longer have to hike its rates, as the higher yields in the US have done much of the heavy lifting for the monetary policy of the US central bank, has led to the US dollar coming off its recent highs. And we had basically a several months long uptrend in the US dollar, as we can see here. The inverse on euro dollar, we have come off the July high from 112.75 all the way down to 104.60 with regards to euro dollar, but have on Friday basically here risen above the previous highs going back to the end of September. And that is bullish, because basically we've taken out the last recent highs. And you can see here we now have, since the beginning of October, a series of higher highs and higher lows, which is the definition of an uptrend. And yes, it looks weaker because the rate of ascent is not as great as the rate of descent has been since July of this year. But nonetheless, the fact that we've broken through the July to November downtrend line, the 55-day simple moving average, and also risen above the late October high, puts now the 200-day simple moving average here in red at 108.07 back on the map. And above there, we also have resistance coming in at the July low at 108.34. So these are the short-term upside targets for euro dollar, as the US dollar is likely to continue to weaken in the following weeks, since no more rate hikes are expected to be seen in the US. Now, if we were to manage to break above 108.34 and close above that July low, I should say, then the next upside target zone would be made up of the late August high and also the June high between 109.45 and 110.12. So that is a definite potential upside target for euro dollar for the coming weeks. And it will remain valid as long as this key support area, which basically held at the beginning of October between 104.84 and 104.44 going back to December of last year, underpins the currency pair. And this looks to be the case, as I don't expect it to be retested, since we've now broken through this downtrend channel, the downtrend line, I should say, on this daily financial bet chart. And the story is quite similar with regards to the British pound. Last week, it rallied by about 1.5% against the US dollar. You can see here very sharp acceleration to the upside, and that was on the back of softer than expected non-farm payrolls data. So basically showing us that employment rates in the US are basically falling. The unemployment rate is rising, and therefore the US economy is cooling down. And that has led to the British pound rallying against the US dollar, and also closing above the 11th of October high at 123.37, which means that technically we formed a bottom, and that we should not just rally above the red line here, the 200-day simple moving average 124.36, but also head back up again towards the late July and also the mid-August lows between 125.91 and 126.17. So these represent the next upside target area for cable in the days and weeks ahead. Now, with regards to short-term support, that could happen around the 55-day simple moving average 123.33. And then we've also got the late October high at 122.89, which is a potential support level. But the trend's your friend, and that is now reversing to the upside, and it is pointing higher with regards to the British pound against the US dollar. Now, in Japan, the story is slightly different because you can see here the US dollar against the Japanese yen rallied last week to a 33-year high at 151 yen and 73 sen before gradually coming off again and retesting this tentative July to November uptrend line today at around 149.38. And basically, we've held there so far as the Bank of Japan, in its monetary policy minutes, redefined its 1% long-term target interest rate as a loose upper bound rather than a rigid cap. And it also removed its pledge to guard the level. And you may remember that this level with regards to the long-term interest rate had been raised to 1% in July, whereas beforehand it was at 0.5%. But basically what we're seeing here is no longer further strength being seen with regards to the US dollar versus the Japanese yen, but basically just some consolidation taking place here on that tentative uptrend line. Now, from a technical perspective, provided we stay above the late October low at 148.81 on a daily chart closing basis, we are still pointing upwards because we still have a series of higher highs and higher lows. But a fall through 148.81 on a daily chart closing basis could indicate a minor top formation and could lead us back down again towards the orange line here, the 55-day simple moving average at 148.40, and perhaps also back down to the early October low at 147.29. The US dollar we said started to come off this week as alongside US yields, with the 10-year yield dropping by over 35 basis points, which is the largest one-week drop we've seen over the last 12 years if you exclude the COVID momentum moves we saw back then. And basically the weaker US dollar over the last few days has led to the gold price basically also leveling out. As you can see here, we did hit a $2,009 per troy ounce high back at the end of October, below which we've been range trading with lower volatility, as you can see here, over the last week or so. And basically today you can see also very little volume and volatility occurring with regards to the gold price. Now, from a technical perspective, provided we stay above the last reaction high, that low, I would say, the low, which is lower than the one to its left and to its right on the daily candle here, that was made last Wednesday at $1,970. Provided we stay above there, the uptrend still remains intact, but a fall through that level, that is to say $1,970 per troy ounce, would indicate a top formation, could take us back down again, not just towards the September lows between $1,953 and $47, but also towards the 200-day simple moving average, $1,935. So consolidation and possible topish consolidation being seen with regards to the gold price here. Now, when we look at the oil price, both Saudi Arabia and Russia have announced that they would stick to their output cuts until the end of the year. That has led to a boost with regards to the oil price. As you can see here, it's bounced off last week's low at $79.97 per troy ounce, not per troy ounce, per barrel, I should say, sorry. And basically, we are heading slightly higher again towards the $82 mark. But as long as we stay below Friday's high at $83.39 on this daily financial bet, the trend is your friend. That's still pointing down. So unless we take that high out, we could actually over the next few days and weeks slide further, not just towards the August low at $77.60, but also towards the 200-day simple moving average here in red, which is slightly above there at $78.03. So that is the analysis with regards to Brent crude oil. And today I'd like to finish up on the technical look at the natural gas prices in the US, which last week basically rallied and closed above the early October high at $3.66.5 before then starting to come off again. Now today we have a gap here which might be filled with Friday's low. That was made at $3.51 or 52 cents. But further consolidation below this high here at $3.66.5 is likely to be seen. But from a technical perspective, provided we stay above the low that was seen at the end of October at $3.35, the uptrend remains intact, and only a fall through here could take us then back down towards this key low here on the 20th of October at $3.18. And if we were to fall through here, then a top would be formed. But unless that happens, we have a sideways trading range with a bullish bias still in place for the US natural gas price. Thank you very much for watching Charting the Markets with me, Axel Rudolph. Please feel free to follow me on X. My handle is @AxelR_IG.